Hello and welcome to GIBS Business. One of Nigeria's leading economists, Bismarck Riwale, the MD of the financial derivatives company, was recently in South Africa. I spoke to him about Nigeria's sophisticated economy, its demographics and growth plans. Bismarck, welcome to South Africa and welcome to our studios.
Thank you.
Now, it's become quite a talking point, the rebasing of Nigeria's GDP, which now makes it the leading economy in Africa. What does that mean?
What it means is that Nigeria's GDP goes from $305 billion, equivalent in nominal terms, to $425 billion, using the base year of 2010 rather than the base year of 1990.
It's been a phenomenal story in terms of growth in Nigeria, but one that a lot of people think has taken quite a long time to achieve.
The reality is that the GDP output of Nigeria hasn't changed, and it's not going to change because of this rebasing. It only means that in comparison to other countries who have used more recent base years, the numbers are more realistic. So for an investor, for example, he knows the size of the market based on that, rather than comparing Nigeria at $305 billion to Ghana at $30 or $40 billion. So it now knows that the Nigerian economy is more than 10 times the size of the Ghanaian economy. He now knows that Nigeria is the largest economy in Africa compared to South Africa. Having said that, nominal numbers are different from effective numbers. What it does mean is that the rate of growth after this is going to be slower because of the law of large numbers. It's easier to grow as a small number than it is to grow as a large number. And it doesn't take away from the fact that there are some structural changes that need to take place to sustain the growth rate that has already been achieved.
Given that, the Nigerian economy has been impressive in terms of growth.
Yes.
What are some of the key elements that have driven that growth?
The key drivers of growth, if you look at it, it's been telecommunications, it's been wholesale and retail trading, it's been construction and building and construction, it's been hotel and restaurants, and to a large extent, agriculture. But what you must know is that between the last base year and this base year, where telecoms we had only 400,000 fixed lines in Nigeria. Today we have over 120 million lines, right? So the rebase is going to give telecommunication its real place in terms of the mix of the economy. Building and construction. In 1990, refineries were a huge part of the Nigerian economy. Today, the refineries are not as big as they used to be, and quite frankly, Nigeria imports refined oil. All of this is reflected in one, the nominal GDP, and two, the composition of the elements that make the GDP.
That's something that's also been spoken about quite often, the diversification of the economy.
Yes.
But some industries have lagged behind. Agriculture, for example. Nigeria used to be a net exporter and now is importing.
No, I mean, that's natural. In all economies, including South Africa and the US, resource-rich economies are giving way to innovation and creativity. And modern tools, the IT revolution, has actually increased the relative contribution of technology and services relative to resource production. So I can tell you that in Nigeria now, the telecoms industry, the media industry, the creative art industry, Nollywood, are huge contributors compared to what they were. In fact, some of them did not exist in the year 1990. So yes, some sectors are going to reinvent themselves. Some sectors are going to fade away, while some new sectors are going to come onto the screen, onto the scene.
Nigeria falls within the ambit of emerging markets, and we've seen some volatility in the emerging markets. How do we ensure that Nigeria can insulate itself from some of these external shocks? Well,
short term, you look for direction, and long term, you look for value. The value of the Nigerian economy is there. The short-term volatility in market prices are just activities of speculators on one hand, activities of institutional investors who are trying to actually rationalize their own decisions whether to short or go long on a particular product or particular commodity or particular market. After all of that volatility, the market will come back to normal. And you will find that the Nigerian market, because of its strong fundamentals, because of its vibrant people, because of the size of its market, will always come out on top.
One of the things that South African investors, for example, going into Nigeria have faced is not understanding those demographics and the sophistication of the Nigerian economy.
You can dimension the risks. Some of them are political, some of them are institutional, some of them are actually market risks. If you dimension it properly, you can actually mitigate and manage some of those risks. For example, MTN came into Nigeria, paid $285 million 15 years ago. And ever since then, that industry has invested $25 billion, right? And no question about the fact that the market has enormous potential. Enormous potential.
Talking about that potential, Nigeria has got a well-documented and very ambitious growth plan, the development plan for 2020. Where are we relative to some of those targets that have been set in that development plan?
Well, in 2020, we're supposed to be at $900 billion of economic activity. Now, after rebasing, we are 50%. So there's 5 more years to go, and I doubt that some of those targets will be met. Some of the targets were very ambitious. But the important thing is that let us look at where we were and where we are. We've actually come a long way. Are we where we could have been? No. So potential GDP is growing at 11%, while real GDP is growing at 6%. That explains it, the difference between the potential and the real. Why is this? There are constraints. The most important constraint being power, road networks, refinery ports. Is there something made on about it? Yes. So power reform has taken place. The assets have been handed over to the private sector. We are not seeing the results now. We'll see the results next year. Refineries is a major issue of change of ownership and government exiting that business. And agriculture using new seedlings, new fertilizers, better land preparation. Monetary policy, keeping inflation at 8%, which is keeping positive real interest rates. I think, by and large, there are positive things about the Nigerian market.
Last question for you, Bismarck, is what's the impact that Nigeria's growth has had in the region?
Well, that's a big question and very important. While we have seen income grow, we've seen income inequality actually grow. So the income is stranded at the top of the pyramid. The challenge today is how to make it go all the way down to the middle of the pyramid and also the bottom of the pyramid. There's stark income inequality. There's very little social mobility. And these are issues that have been addressed and need to be resolved very quickly.
Bismarck, thank you so much for your time, and we wish you all the best. Andrew Marshall is the outgoing CEO of Nampak, Africa's leading packaging company. At a recent GIBS Forum function, Andrew spoke to us about his company's investments in Africa and offered valuable lessons about doing business on the continent.
We see ourselves really as being sub-Saharan Africa, so we don't see ourselves in the Arab part of Africa, and that's just to do with culture, and those economies really look north, they don't look south. The profit we're making in Africa is 500 million rand a year. So this isn't just the politically correct thing to do, this is a serious generator of profit for us. So those are the main countries where we do operate, and I've highlighted the ones where the big growth is happening, which is essentially Nigeria, Angola, Ethiopia, and we are busy entering Ghana as we speak. Okay, key thing for us in terms of the strategy is that we start off with exports, obviously. It's the normal route that South African companies go. You export into the continent. You get to a certain size, and it's then a question of putting in the local manufacture. For us, we really do partner with the multinationals, and in a way it's easier for us. We don't have to go and develop a brand. We really do a deal with SAB or Heineken or Coca-Cola or Pepsi or BAT, whoever it is in place, before we'll put in a major investment. So if I give you an example of Angola, or pick any country, and we're going into Nigeria, we'll talk about a bit about that in terms of some beverage can investment. Before we conclude that deal, we will have concluded back-to-back supply agreements with the major players, the Heinekens, the SABs, the Cokes, the Pepsis, Diageos, and we will not go ahead with that deal until we've got those long-term supply contracts in place. And we did the same with BAT. Before we put in the cigarette carton operation into Ibadan, which is 130 kilometers north of Lagos, it's literally alongside BAT. We'll only do it if you give us a long-term supply contract, and the margins are guaranteed, pricing is guaranteed. We pass on any increase in raw material, and we pass on any decrease, so we protect our margins through the duration. Obviously, looking at it from their perspective, in almost every instance, we are replacing imports. So the cost of getting that product to Ibadan, say, or into Addis Ababa, it's just prohibitive. So we can actually get a better margin as a result of that, because we're way under the price that they're paying for imports. And that's really the dynamic, is that they're doing better. So our latest investment in Addis, for example, is a crate line. We have a back-to-back contract, long-term contract with Coca-Cola there. But those crates are being imported through Djibouti, if you're familiar with the geography of Africa, across this impossible road system, through multiple borders, to get it to the Coke factory in Addis. I mean, the price by the time you get it there is prohibitive. So as long as we're below that price, and we're way below that price, they'll give us a long-term contract. But clearly the price we get there is better than South Africa, because here or in Europe, they just put out a tender. 10 people put in their prices and they pick the lowest. So that's the dynamic effectively. So the key is we then partner with the multinationals, we lock in the long-term contracts, and then once we've done that, we look to broaden our range. So we've gone in, let's say, into Nigeria with BAT, and we're doing all their cigarette cartons. But once we're up and running, those same lines that print gravure cartons for the likes of BAT can actually print high-quality labels for Heineken, or they can do the toothpaste tube boxes for Colgate and emboss them and do all the right stuff. So we then just broaden the range, and we start doing metals and closures and crates and everything else. So in Nigeria, for example, we've now got 3 factories, which we started at 1, and now we're doing all these other things, introducing closures and things like that. And I always, when I get asked about the risks in Africa, I argue that a lot of the business risks are lower there because we don't have labor problems. I mean, I cannot recall a single labor strike in my 5 years at Nampak anywhere in Africa. I cannot recall a month in South Africa when we haven't had labor problems. So it's, you don't have that dynamic to contend with. And then, of course, your volumes are growing and your margins are not under pressure. So your client base is growing and his focus is on give me more. So we've run out of capacity in Angola. Our beverage cans, we put in a line, commissioned 2 years ago, doing 20 million cans a month. It's now doing 70 million cans a month, and we can't cope, hence the new capacity. When your client cannot get enough cans, the last thing on his mind is, I want a better price. It's just give me the damn cans. We'll worry about the price next year. And that's the dynamic. So for us, it's a huge opportunity. And I argue that there are risks in Africa, infrastructure, political. But from a pure business perspective, we do not find it that difficult operating in Africa. We find we're used to running there, we're used to operating there. Sales are growing fantastically, margins are much healthier, and the sort of key risks for business people in terms of sales, margins, labor are much lower there than here in South Africa.
Andrew goes on to explain how they operate in each of the African countries and their growing profit margins.
Just a slide to give you a sense of what we do in the different countries. So if you look at Zambia there at the bottom, you'll see that Nampak is manufacturing most of our products in Zambia because we've been there quite a long time, and we've grown there to doing crates and closures and a whole range of products. If you look at Angola, where we're pretty new, or Ethiopia, you'll see that just 1 or 2 crosses on that line, but clearly that's the opportunity. We really do expect in each of these countries to roll out all the others. And if you take Nigeria, you can see, I don't know if it's coming across well, but these are reds here, which are proposed, but some of those have already happened now. So the closure line is now up and running in Nigeria. And that gives you a sense of how our trading profit from Africa has grown in the last few years. So it's phenomenal growth. But just to give you a sense, in 2011, this is just our operating profit from Africa over here. But you can see where we were. So in other words, we've got this 500 million profit coming out of Africa. So just put into perspective how significant Africa is. And bear in mind, average margins here. If you took Astropac, average margin in Astropac, they make about 8% in rigid, nothing in flexibles. It's about a 50-50 business. Their average margin is 4%. We're making 18% in Africa and growing.
So remember, when investing in Africa, it is useful to partner with a multinational operating in that country, have long-term supply contracts, and constantly seek to broaden your range. Thank you to Andrew Marshall for those tips. Until next week, take care.